Good evening everyone and welcome back. This is day 4 of the CA Inter Fast Track course for tax. We've completed GST, we've also done all the MCQs suggested by ICAI, and now we're looking at DT. In just the session before, we did a couple of chapters which were basically introduction, we did house property, we did agriculture income, and we did exempt income. Now we're looking at one more chapter, and then we are also looking at the questions from the book. So here we go. I'm first up going to be, just one second, I'll just upload. I just need to convert the Word document into PDF so that we can do it here. 1 second. Guys, exempt income, good evening everyone. Exempt income is something that I'm looking forward to do. We've finished the entire chapter. It's a very happy section because they don't pay tax. In this session, besides this exempt income questions, we're also going to look at a couple of other things. Like after this, we will look at residential status and scope of income and deemed income. If that gets over, we will enter into the world of IFOS. We'll see how that goes. But right now it's our time to do the module and to do the questions from the module. Here we go. This is the exempt income chapter. I'm going to go to the last page and do whatever questions we can do from here. Here we go. This is question number 5, question number 3, 2 and 1. Guys, your participation is important and it will also help me understand how much you've understood. So here we go. Examine whether the following incomes are chargeable to tax, and if so, compute the amount liable to tax. Arvind received 20,000 as his share from the income of an HUF. This is exempt under section 10(2). Mr. Xavier, a Paramveer Chakra awardee who was formerly in the service of the central government, received a pension of 2,20,000 during the financial year. This is pension for a gallantry award winner, exempt under 10(18). Agriculture income of 1,27,000 earned by a resident from land in Malaysia. This is taxable under IFOS. Rent of 72,000 received from letting out agriculture land for a movie shooting. This is taxable under, this is agriculture land, this is land, so IFOS again, not IFHP. Let's go to the second question. Examine the taxability of agriculture income under the Income Tax Act. How will the income be computed when individual derives agriculture and non-agriculture income? Guys, here you will say that agriculture income is exempt under section 10(1). However, in case the agriculture income is more than 5,000 and non-agriculture income is more than the basic exemption limit, then aggregation will have to be done and the scheme of partial integration will apply. Also, when you have both incomes, agriculture and non-agriculture, this is rule 7A for rubber, 7B for coffee. This kind of question will not come theoretically, but overall the concept you should know, and rule 8 is for tea. Perfect. Next, whether the income derived from saplings and seedlings grown in a nursery is taxable. Guys, seedlings and saplings, whether grown on land or in a nursery, it will be exempt, and this one will also come in agriculture income. Next, examine the reasons in brief whether the following statements are true or false with reference to the provision of the Income Tax Act. Just 1 second. Perfect. Exemption is available to Sikkimese individual only in respect of income from any source in the state of Sikkim. This is partly true, partly false, because any income from Sikkim plus interest and dividend from entire India. Pension received by a recipient of gallantry award who was a former employee of the central government is exempt from tax. Yes, under section 10(18). Mr. A, a member of HUF, received 10,000 as share from an income of HUF. The same is included chargeable income. No, this is exempt. This is also done 10(2). Next, guys, this is a 10AA SEZ unit. Rudra Limited has one unit in an awesome area and another unit in a domestic tariff area. So this is Rudra, the total amount. This is unit in domestic tariff area. So we will calculate SEZ area. First calculate the amounts, guys. Total sales 6 crores, 2 crores. So this is 4 crores. 4 lakh 60, 1 lakh 60, so 4 crore 60, 1 crore 60, so 3 crores is export sales. 80 lakh, 20 lakh, so this is 60 lakh or 0.60 crores. Guys, these are the SEZ units because I want to only focus on the SEZ numbers. Calculate the amount of deduction available under 10AA for the year 21-22 if both the units were set up in the year 14 and both the units were set up in 18. If you were set up in 14, guys, you are in the second series of 10 or 5 years, so this is 50% deduction under 10AA and this is 100% deduction in the first 5 years. Guys, what will you find out? You will find out the export profit first. So find out the export as a percentage of total turnover. 3 crores divided by 4 crores into 0.60. That's all you need to do, guys. 3 crores is export turnover. 4 crore divided by total turnover into profits. So 3 divided by 4 into 0.60 is 45 lakhs is the exemption. If it's in the first 5 years, sorry, it's in the second 5 years, then only 50%, that is 22 lakh 50,000. And the next, if it's in this, if starts in 2018, then in the first 5 years, then the entire 45 lakhs will be exempt. This is section 10AA. As per section 10AA in computing the total income of the SEZ unit, guys, this kind of question does not come. Generally, a practical question comes on this, so you don't have to write too much of theory. You just have to show how you got that answer. So basically, if you're in the first 5 years, this is in the second 5 years, you get 50% of that, that is 22 lakh 50, and the first 5 years you get 100%, that is 45 lakhs. Perfect. That's it. Yes, guys, that's about it. That is the exempt income. We are more looking at more questions. Don't worry, this is just the questions that we do while we do a particular chapter. So we're done with exempt income questions as well. Now let's go to residential status, scope of income, deemed income, this one. Perfect. I'm just going to upload the quick book as well. Here we go. This is the quick book. Last class was on March 7th. Nandish, I've already explained the entire schedule. Please watch the first class from the beginning. I've already explained the entire schedule in that, please. All right. Guys, this is the quick book. We are at residential status and scope of income. First, I want to discuss scope of income and then I will discuss residential status. Guys, scope of income means what? For a person, which incomes are taxable, which are not, that is scope of income. So I'm discussing that first. Everyone, all eyes on scope of income. Guys, there are 3 kinds of people. One is a resident, an ordinary resident. This guy is perpetually sad because his entire global income is taxable in India. Whether the income is in Malaysia or Mumbai or Miami, doesn't matter. He will pay tax in India. Why? Because he's a resident in India. And at the other end, there's a non-resident who's very, very happy. Why is he so happy? Because for him, only 4 incomes are taxable in India. If you remember the shortcut, the 4 incomes are dear income. Incomes that are received in India, incomes that are earned in India, accruing in India, and deemed to accrue or rise in India. Only these 4, yes, only these 4. And then there is a resident who is another type of resident. Only in 2 cases we have R and OR. Who is actually a resident. These both are resident, but he's very similar to a non-resident. He is also very happy. Why? Because only dear plus 1 income is taxable in this case. What is dear plus 1? The same dear income which is here plus 1 income. What is this plus 1? Income that is actually earned abroad. A hotel in New York, a business in London, but which is controlled from India. This is that income which is taxable in India, earned abroad but controlled from India. So again, summarizing, resident, entire global income, he's sad, but non-residents and RNORs are happy because dear and dear plus 1 income. This is scope of income. This is section 5. And guys, this has some really, really good conceptual clarity. The moment in the exam you know a person is a resident, tax everything. The moment you know a person is a non-resident RNOR, only tax what is earned in India, nothing more. Or sorry, not earned, what is dear income and dear plus 1 income. Guys, what is dear? In detail, let's go. First is received in India. Received in India means you receive in a bank account in India. SBI account in Mumbai is in India, but SBI account in Nepal is not in Mumbai or not in India. Next, earned in India. Example, your salary that you earn or your business income that you earn. Accruing in India, till you earn it, it accrues to you. Example, when you make an FD, the whole year the interest accrues to you and you earn it only on the last day. So that is accruing in India. And deemed to accrue or rise, we will see ahead in this chapter only in section 9. So we'll keep D pending. This is deemed to accrue or rise in India. So dear income, and this is dear plus 1 income. This is done. But remember guys, any remittance is never taxed. So if there is a remittance, that is never ever taxed. Example, the income was earned in the year 2016-17 and now in the year 21-22 it is remitted into India. Will it be taxed again? No, remittance is never ever taxed. But what if guys, in 16-17 it was not taxed? Will it now be taxed? No, no, no. Let me tell you, you are not a government. Don't behave like one, don't think like one all the time. In this case, don't think like one, think like an individual. Guys, if I have earned some income which is not taxed in 16-17, why are you taxing me right now? So this one guys, the moment the word remittance is used, you will not tax it. One last question I will give you, please answer. I am not seeing participation from people, I am only seeing observers and spectators. Guys, I want more participations. Guys, this is the year 2021-22. You earned some money in this year which you have later on remitted. Will this be taxable? You've earned some money this year but later on remitted. Guys, I'm very disappointed with the answers. Please tell me, you are ordering food today, tomorrow you are going to throw it out. Are you going to eat today or are you going to order it today? Are you going to pay the bill today? Yes, everything is happening today. If you earn the income today, later on what you do with the money? I'm giving you another question. You've earned salary today, tomorrow you're going to buy an iPhone. Will your salary be taxed? Guys, then why are you going wrong? This is a very basic question. You are earning income today, it's going to be remitted later on. Is it going to be taxed? Yes, you're earning income today. Whichever year you're earning income, in that year it will be taxed. Remittance later on, whatever happens we'll see later on it will not be taxed again. All right, perfect. Moving ahead, this is section 5. This is scope of income, just reading it from here. What is a resident? What is a citizen? A citizen is basically where you are born, where is your passport, that is a citizenship. A resident tax is global income, non-resident is taxed only on dear income. Explain the concept of dear income. Deemed to accrue or rise in India, earned, accruing and received in India. Remittance is never taxed. Receipt is the first receipt, remittance is later receipt. Only the first receipt to tax. Remittance is never taxed. And difference between RNOR and NR is only one income, income which is abroad but controlled from India. Perfect. Guys, look at this exception. In case of a non-resident who is a seafarer, example, you are on the ship guys. You are actually from India, but you are always on the ship, sometimes in Malaysia, sometimes in Sri Lanka, sometimes in Japan. You are always on the ship. Where will you get your salary guys? You will get your salary in India in a NRE account. So if you are always on the ship, will you be a non-resident? Yes. But it's received in your NRE account in India, will be received in India and taxable in India. It should be, but this notification says it will not be taxed in India. Don't worry. In case of a non-resident, salary received for services rendered outside India, even if received in NRE account, will not be included in total income. This is an exception only for seafarers. So repeating, if you're a seafarer, that means you're always on the move and you get some amount in an NRE account, it will not be included in your total income. Don't worry about it. Perfect. And with that guys, we go to the next leg, that is residential status. Residential status is basically section 6 of the Income Tax Act, of course, and section has 4 parts to it: section 6.1, section 6.2, section 6.3 and 6.4. This one is only for individual, this one is only for HUF, while it is very similar to others. This one is only for companies. Let's go backwards guys. First, for others. Your residential status you will check every year, yes. For others, that means partnership firm, AOP, BOI, AJP, everyone else, it depends on your control and management. If there is any remote, even 1% India connection, then you are a resident. But if it is fully abroad, the control and management, then you are a non-resident. Same thing for an HUF also. If there is any India connection for the HUF in terms of control and management, then resident. But if it's fully abroad, only then the HUF will be a non-resident. Example, Karta, Kopasnar, everyone are in Australia, then it's a non-resident. But one person is in India taking decisions, then is a resident. So even 1% if it's in India, if there is any India connection, then these both will be residents. Here we will bifurcate it further into ROR and RNOR, which we will see very soon. Now comes to companies. Guys, for companies it is not based on control and management. Indian companies, that means registered under the Indian Companies Act, yes, always and always resident. So what is Reliance Industries? Resident. ICICI Bank? Resident. Kotak Bank? Resident. What is Unacademy? Resident. But if it's a foreign company, then guys, foreign companies write beautiful poems, guys, very melodious poems. And if the poem is written in India, that is place of effective management, if it's in India, then it is a resident. But why will they come to India and write a poem? Elon Musk hardly comes to India. So if they write the poem abroad, then it's a non-resident. This is only for foreign companies. Indian companies, you don't even have to think. So Indian company and foreign company. Indian company is a resident. Foreign company, you will depend upon poem. Guys, this is section 6.2, 6.3 and 6.4. Residential status has to be checked every year. Now we come to the most important, and this is sure shot in your exam, guys. This one, section 6.1. Let's see how 6.1 works. For section 6.1, whether it's you, whether it's me, whether it's Salman Khan, whether it's Shah Rukh Khan, whether it is any actor, any actress, any sportsman, Virat Kohli, or even the Prime Minister of the country, section 6.1 says you have to base it on certain basic questions and additional questions. Basic condition 1, is your stay in India during the previous year greater than or equal to 182 days? If your answer is yes, then you are a resident. But if your answer is no, we are not going to give up so easily. If your answer is no, we will go to basic condition 2. But before we go to basic condition 2, stop yourself, because this basic condition 2 does not apply to two people. Who are those two people? Indian citizens or PIOs visiting India. Indian citizens, you know who are PIOs. PIOs are persons of Indian origin. That means not you, but your origins are Indian. Your parents or grandparents were born in India, including undivided India. If you are an Indian citizen or a PIO visiting India, then basic condition 2 does not apply. So guys, if there is, let's say you or Sundar Pichai, let's say Sundar Pichai is still an Indian citizen or a PIO, when he is visiting India, will you apply basic condition 2? No, you will not apply. And second person to whom basic condition 2 will not apply, if you are an Indian citizen only, yes. If you are an Indian citizen who is leaving abroad or who is leaving India for employment abroad or for joining a ship abroad, then in that case, this is during the year you have to leave. If you are leaving India for employment or for joining a ship abroad, then in that case the second basic condition does not apply. This is second basic condition, which does not apply to two people. So when you go to basic condition 2, stop yourself always and ask, are you an Indian citizen or PIO visiting India? Then this condition does not apply. Then how do you decide? Only based on basic condition 1. Or if you are an Indian citizen leaving India for employment or joining a ship. Now basic condition 2, what is it? Is your stay in India during the previous year greater than or equal to 60 days? And is your stay in India in the preceding 4 years? What is preceding 4 years, guys? Not this year, before this year. This is the previous year, before this year, greater than or equal to 365 days. Then if both of them are fulfilled, then congratulations, you are a resident. But if this is also no, then we have to finally give up and that person will become a non-resident. So guys, is your residential status based only on two conditions? Yes, it is based only on two conditions, 1 and 2. Guys, please tell me, is the sign the same? Yes. Is it both in the previous year? Yes, one in preceding 4 years. While you are calculating number of days, the day you leave India and the day you arrive in India should also be included. Yes. So if I leave abroad for abroad, guys, on the 1st of March, I am leaving, so hence 1st of March will be included in India. And if I come back on 14th of March, even 14th of March will be included in India. This is for everyone except those people who are going on the ship. For those people, because they go on and off the ship very often, you have to see the continuous discharge certificate, and in that the day of entering the ship and the day of leaving the ship are not included. So that is an exception only for people who are working on the ship. The continuous discharge certificate we'll have to see, and the people who are joining the ship and the people who leave the ship, that day, those 2 days will not be included. That's an exception. All right. Now with this, guys, you come to know whether you're a resident or non-resident depending upon how long you've stayed in India. But guys, not every one of the residents is treated alike. There are some residents who are punished almost with ROR, and there are some who are rewarded like an RNOR. So this depends upon 2 further conditions which are called additional conditions over 2 years. Additional condition 1 and additional condition 2. Guys, will you ask these additional conditions to a non-resident? No, a non-resident is happy, you will not disturb him. Only to residents you will ask these 2 additional conditions, additional condition 1 and additional condition 2. Do you have to ask both? Yes. If both are yes, only then you become ROR. Even one of them is a no, you become a RNOR. That's how to remember it. What is additional condition 1 and additional condition 2? They both take you into flashback mode. Guys, I've changed the condition, but the still conditions are the same. I've changed it only for the symbol. In additional condition 1, you have to go in the last 10 preceding years. And additional condition 2 in the last 7 preceding years. In the last 10 preceding years, were you a resident in at least 2 or more years, so greater than or equal to 2 years? And in the last 7 preceding years, was your stay in India at least greater than or equal to 730 days? So what I've done is, I've changed the basic and additional conditions to make sure the symbol are the same, greater than or equal to, greater than or equal to. Additional condition 1, additional condition 2, 10 years, 7 years. Resident in 2 or more years, stay in India greater than or equal to 730 days. If both these conditions are met, you are a resident. Even if one of them, you are an ROR. Even if one of them is not met, you are an RNOR. Guys, this is residential status, and this used to be the case till 2 amendments were introduced. So I'll show you the amendment and I'll tell you when to use it also. Don't worry, I'll give you a pro tip for amendment as well. Perfect. Now guys, all this is good, but the government in the year 2020, in the Finance Act 2020, which obviously applies to you because till Finance Act 2021 everything applies to you. In the Finance Act 2020, the government made 2 amendments. The first amendment, which I'm going to call A1, is this. They say that if you are an Indian citizen or a PIO, generally basic condition 2 does not apply, but if you are Indian citizen or PIO who is rich, that means your Indian income or your DIR income is greater than 15 lakhs. Not greater than equal to, but this is only greater than 15 lakhs. If you are an Indian citizen PIO and your Indian income is greater than 15 lakhs, that means you are rich, then the second basic condition 2 will apply. Yes. But in the second basic condition 2, can you see 60 days? That will be replaced by 120. The rest of the question will remain same. Yes. So in that, 60 days will be replaced by 120 days. And if your answer is yes, that means you stayed in India for 120 days or more and the last 4 years for more than 365 days or more, then you will become an RNOR. So the amendment's intention is not to do anything but to just increase RNOR population. The intention of this is only to increase the population of RNOR. That is the first amendment. Guys, repeating the first amendment, does it apply to everyone? No, only to Indian citizen PIO. Does it apply to every Indian citizen of PIO? No, only whose dear income is more than 15 lakh, that means only who's rich. And here the basic condition too, you have to check yes. If it's yes, then you become a RNOR. Pro tip guys, in the exam first finish all of this. Then when do you check the amendment? You check the amendment only if they give you dear income. Otherwise you don't check for amendment. In the exam, if they give you Indian income, only then check for this amendment. Next amendment, amendment 2, is only for Indian citizens. So there is a difference. Yes, this is for Indian citizen PIO. This is only for Indian citizen. Again, who's rich? That means the dear income should be more than 15 lakh. And if you are an Indian citizen having so much income and you are not taxed as a resident in any country of the world, then don't feel lonely, don't feel alone. We are with you to tax you. We will tax you as an RNOR. That's the idea. That if you're not taxable, why? How can you not be taxed in any country as a resident? Because you're trying to avoid residential status in every country. Then don't worry, we will treat you as a resident and not ordinary resident. But guys, what if I'm in Dubai? What if I'm in UAE? I'm not taxed because it's exempt. Then it's okay. But if you are deliberately trying to, stay away from being taxed as a resident in any country, then we will tax you. Let's compare. This is to Indian citizen PIO. This is only to Indian citizen. This is dear income greater than 15 lakh. This is also dear income greater than 15 lakh. Here you have to check whether you are a resident in any country of the world. Here you have to check basic condition 2 with a small change. And both these cases you will be a RNOR. Yes. So there are two differences. This is a difference and this is a difference. And there are two similarities. These are similar and these are similar. I hope you understood guys. This is going to be there in your exam for sure. Just repeating, basic condition 1 and 2. When you go to basic condition 2, 2 people it does not apply to. Additional conditions are only asked to resident to make sure we are RNOR or ROR. And these two amendments only apply if the exam, if they give you dear income more than 15 lakhs. Otherwise, how will it apply? So these amendments are only if you are rich. Both the intention is to make only RNOR, nothing more. Alright. Let's check it. And one thing more. For an HUF, also we have ROR and RNOR. So here the same additional condition 1 and additional condition 2 will be asked. But you will ask the Karta that in the last 10 years, in the last 7 years, the same Karta you will ask. And if the Karta says yes for both, then the HUF will be a ROR. Otherwise, it will be an RNOR. So that means the same additional conditions, yes. But asked to whom? The Karta. And if both are yes, then the HUF will be a ROR. Here you go. 6.1 for individuals, basic condition 1, basic condition 2. Basic condition 2 will not apply to the following people. Additional conditions are given in section 6.6, additional condition 1, additional condition 2, last 10 years and last 7 years. Day of arrival, date of departure are to be included except CDC. Finance Act amendments, 2 amendments. First one is for Indian citizen PIO, second is only for Indian citizen. By the way, the second one has a section called section 6.1a. The first one is not a section. It's under 6.1 only. For HUF, control and management, and 2 additional conditions. For companies, Indian companies, you don't have to think. Foreign companies, you have to check where they're writing the poem. And for all others, you will have to check 6.4, that is control and management, as this is your residential status. Perfect. Guys, I hope this is understood, and I hope if you're having a question, you're asking me any relevant doubt. Perfect. Perfect. Now guys, the next and the last bit is deemed income. This is the dear part, the D part, deemed income, which is under section 9(1). Guys, do you think the Indian government is greedy for taxes? Do you think they want taxes? Yes. How else will we develop ourselves? We want a lot of taxes, and sometimes there is confusion about a certain tax, and Indian government doesn't like this confusion. So what do we do in that case? We bring a section called 9(1), and in that we have 8 such incomes: I, S, S, D, I, R, F, and this is a gift. Yes, this shortcut is a gift. So just one second. I, S, S, D, I, R, F, gifts. So these are 8 incomes under which section? Under the section deemed income 9(1). And these 8 incomes, there is some amount of connection with India, some amount of argument with India. So India says, listen, I don't care what you're thinking. Foreign governments, I don't care about you. I'm going to snatch these incomes and tax them in India. So will these be taxed in India? Yes. And what will you tell them when they are taxing them in India? We will call them as deemed income or deemed to accrue or arise in India. Let's check one by one. But this will never apply to a resident and ordinary resident. Why? Because for him anyways, every income, whether it's IS, SD, IRF or any other alphabet, it's all taxable. So this will be checked only for non-residents and RNORs. Yes. Let's check it for non-residents. RNOR is the same. So this is a non-resident, guys, and he's getting some of these incomes. Let's see how is it taxed. First, gifts. If a non-resident gets a gift from a resident, you have to see all of this from the non-resident's perspective, guys. Please check it from the non-resident's perspective. If the non-resident receives a gift from a resident of more than 50,000, but not cash, gift in kind, sorry, my bad, not gift in kind, in cash, more than 50,000 rupees if you get, then this will be taxable. Yes, it will be deemed to accrue or arise, and the non-resident will have to pay tax in India. What this will do is this will stop any stupid gifts or any tax avoidance gifts that you give abroad to people abroad. Hence, this will put an end to that. So what should be the gift? If the gift is more than how much, guys? 50,000, and it should be in cash or in bank account. What if you've given a mobile phone to your sister abroad? Not on that. Only on gifts in cash or bank account. So this is gifts. Next, I, R and F, all 3 together. If a non-resident is earning interest or royalty or fees for technical services. So whom are you focusing on? Non-resident. The non-resident is earning IRF, that is interest, royalty and fees for technical services from, and who's paying him? Government of India. Is there an India connection? Yes. So this will be deemed to accrue or arise in India, and we will tax the non-resident in India. But if it's being earned from a resident or it is being earned from a non-resident, then we will deem to accrue or arise in India only if it is being used in India. Yes, you'll have to check territorial nexus or usage. The usage should be in India. What it should be used for? It should be used for any business or profession or any income generating activity in India. And obviously, if you're using the money in India, on interest you pay on money, guys, royalty you pay on patent, and fees for technical services you pay on technical services. If those are being used in India, then why should in India tax it? So again I repeat, interest, royalty and fees for technical services. Who's earning it? Non-resident. If from the government, you will not check usage, but if from resident and non-resident, you will check usage, and it should be used for PGBP or income generating activity in India. What is income generating activity? Investing in shares, giving a loan, etc. But guys, there's an exception. Only in case of interest paid by one non-resident to another non-resident. This exception is very important, pay attention. Only in case of interest paid by one non-resident to another non-resident, example, Elon Musk is paying some interest to Bill Gates for money that is being used in India, then the usage has to be only business and profession, not income generating activity. So the usage in India has to be only for business and profession and not income generating activity. That means if Elon Musk is paying some interest to Bill Gates for money which has been invested in shares in India, then India will not get to tax that interest. But if it's used for a business in India, then India will get to tax that interest. This is IRF. Again, I repeat one last time. Interest, royalty and fees for technical services. Who's earning it? Non-resident. From whom? Government, resident, non-resident. In government, you don't check the usage because government of India only. But in the other two, you check usage, and only exception is interest paid by one non-resident to another non-resident. It should be used only for business or profession, not for income generating activity in India. Next is very simple. If a non-resident is earning dividend income from an Indian company, obviously the Indian company is paying you dividend, we will want to tax it in India. The next one, please pay very close attention. This is a non-resident, but he is not any normal non-resident, he is an Indian citizen. And he is working abroad for the government of India. So who's paying him? Government of India. So I repeat, it's a non-resident whom we are focusing on, yes. But he has to be an Indian citizen. Here all these people didn't have to be Indian citizens. This one has to be Indian citizen. This one we are talking about right now. ISS. And the government of India is paying him salary. Why is the government of India paying a non-resident salary? Because he is working for the government of India. Example, the Indian citizen is working in the Indian embassy in France. Guys, because we have many such embassies in different countries and they are taxed at different rates, we tell the government that listen, you all don't tax them at different rates, we will tax our people. So we are going to tax our people. So this salary is earned abroad, accruing abroad, even received abroad, but we snatch it and we tax it in India. This is called salary paid by government of India to Indian citizen working abroad. Will it be deemed to accrue rise in India? Yes, the shortcut is we tax our people, they tax their people. Guys, but only salary is taxed in India. Besides that, he also gets 7 allowances. Those are exempt under a section which I haven't discussed in exemption section because I wanted to discuss here. The allowances are exempt under section 10(7). So this one is very important. IRF is very important. And this one is very important till now. Please make sure salary is being paid by government. Please make sure the non-resident is an Indian citizen. And please make sure this is for salary where you have a reciprocal arrangement. And similarly, when the French citizens come to India, we don't tax them, we exempt them under 10(6)(2). So it's a reciprocal arrangement. And the last two, let's discuss on this side. But this one we'll discuss here only. This is simple. This is again salary paid to a non-resident, but for services rendered in India. Example, we are building a metro almost everywhere in India, and for building the metros we get some Japanese metro employees to work in India for a while. If the services are rendered in India, then why shouldn't we tax in India? So this is salary for services rendered in India. And how do you remember ISSD IRF? Why is this important? Because this is 9, 1, 2, 3, 4, 5, 6, 7 and 8. So in the exam, if you have to quote royalty, then you will quote 9, 1, 6. If you have to quote fees for technical services, then 9, 1, 7. And you have to quote this salary by the French embassy guys, so 9, 1, 3. That's the benefit of ISSD IRF gives. Just 1 second, guys. Perfect. Guys, so now that leaves us with only the first one, that is 911, that is I for income. Income from 3 things, but the only most important one is a business connection. So let's say there is a company abroad in China called OnePlus, and they don't want to have OnePlus India Private Limited because Indian company will be a resident and it will be taxed. So they instead have an agent who is a dependent agent, who has the ability to negotiate contracts or conclude contracts or store goods or take orders, etc. This agent does everything which OnePlus India would do. So hence the OnePlus China makes 10 crores worth of income from this dependent agent. OnePlus India's China sales is 1090 crores, India sale is 10 crores, total sale is 100 crores. Indian government says, listen, this is not right. You've come to India through that agent and you're supplying goods in India, so why shouldn't we tax you? So we introduced a concept of business connection, income from a business connection. So this is a business connection. What is a business connection? A business connection is someone who's a dependent agent, who has the ability to negotiate contracts, conclude contracts, store goods, take orders, etc. And this business connection, because of this business connection, we will tax OnePlus China in India. But don't worry, we don't want to tax everyone, so there's an exception. Some people we don't want to tax, see the exception. The shortcut is India, exports, news, movies and diamonds. This is the shortcut. And these will not be business connection, so these will not be taxed in India. What is this? First, only India attributable income will be taxable. That means even if we tax OnePlus China, we won't tax them on 100 crores nor on 90 crores, but we only tax them on 10 crores. So only India attributable income will be taxable in India. Next, exports. If you are purchasing goods for the purpose of export, if in India you are purchasing goods and you want to export them, that's the only thing you are doing, then that is not a business connection. If you are someone who's providing news and views to abroad, example, if BBC has a news reporter or a few news reporters in India who give them news and views, that does not make these business connection. If you are making Slumdog Millionaire Part 2 or 3 or 4 in India, just because you're filming that in India does not make you a business connection. If you're showcasing diamonds in exhibitions in India and later on you get business because of that, you don't are a business connection. So don't worry, you people who are exporters from India, news collectors, movie makers and diamond exhibitors, don't worry, we will not make you business connection. And even if we do, not to y'all but others, we will only tax your India attributable income. This is the exception to business connection, section 911, this is the exception. But guys, instead of OnePlus, there is Netflix. Netflix USA does not even have an agent in India. They just have an app in India, and through that app they ensure people download and they become users. So for that we could not use the concept of dependent agent business connection. So we included another concept in business connection called significant economic presence. Very important, and it could be there, very important, it could be there in your exam, significant economic presence. They say that Netflix, if you have little bit presence in India, we have no problem. But since you have significant economic presence in India, we will tax your India attributable income. But what is significant economic presence? Significant economic presence means you have a turnover from India of more than 2 crores, or if you have users in India more than 3 lakhs, then in that case you will be considered as having significant, that is a lot of presence in India. Guys, do you think Netflix USA has a lot of presence in India? Yes. But of course, they have an office in India. So this is only a fictional story. But if they did not have an office in India or Netflix India, then we could still tax them because of significant economic presence. So guys, in the exam, if a sum comes that there is PUBG China, which does not have any India office, any India company, but they have a lot of users, can we tax PUBG in India? Yes, if their turnover is more than 2 crores or if their users are more than 3 lakhs. This is a concept of significant economic presence. This is the concept of business connection. This is a concept of 911. Besides that, others are very simple, guys. If you have any capital asset in India, example, you have a land in India which you are selling. Because the land is in India, even if you are a non-resident, you will tax in India, which is very obvious. If you have shares in India, even if you are a non-resident, you will be taxed because the shares are in India. And if you have a property from which you earn income, like a hotel, which you don't sell but you earn income, or a source of income in India, like a petrol pump or a hotel from which you earn income, even if you are a non-resident, it will be taxed in India. Why? Because the property is in India, the source of income is in India. So this concept, guys, overall is 911. Let's do a 5-minute quick recap on section 911 or section 91. Please tell me in the chat box, guys. In 9.1, is it received in India, earned in India, accruing in India, or is it deemed income? Section 9.1, it is deemed income. And how many deemed incomes do we have, guys? How many deemed incomes do we have? We have 8 deemed incomes. Do you remember the shortcut for the 8 incomes? Yes, please tell me the shortcut in the chat box. ISSDIRF gifts. Guys, this you will see for whom? Will you see for a non-resident or resident? This you will only see for non-resident and maybe even for RNOR. Good job, Nikita, Gayatri, good job. Full short form you've given, great. In this case, guys, what is G for? What is G for? Gifts in cash or bank account more than 50,000. IRF is interest, royalty and fees for technical services. Guys, will you check usage if government has paid? No. And do you remember the exception for interest? Yes. D is dividend. S is salary, but who's paying the salary? Government of India. To whom? To an Indian citizen working abroad. This salary is for services rendered in India, and this is business connection. Guys, in business connection, do we now have significant economic presence? Turnover more than how much? 2 crores. Users more than how much? 3 lakhs. And what are the exceptions to business connection? India exports what? 3 things: news, movies, diamonds. Let's read, guys. Section 9, incomes deemed to accrue rise in India, ISSD IRF gift. Income from any business connection in India, 1 plus China example. Business connection is a person acting on behalf of a non-resident. Conditions for an agent to be considered as a business connection. SEP, second condition must satisfy. No, only any one. This is or. In SEP, it is or. Perfect. Exclusive dependent agent habitually enters into contracts, negotiates contracts, maintains stock, secures orders. Exceptions are India exports news, movies and diamonds. In these cases, it will not be a business connection. Next, purchase for the purpose of export, collection of news and views, shooting movies and displaying diamonds. Significant economic presence, more than 2 crores or more than 3 lakhs users. From any property or source of income in India, from any transfer of capital asset in India. 912 is salary for services rendered in India. 913 is Indian citizen paid by a government of India. 914 is dividend 5, 6 and 7 is I, R and F. All of them are similar except for I there is a small exception, and last is gift more than 50,000 in kind. Alright. There's a small section. So guys, we are done with section 5, scope of income. We are done with section 6, residential status, and we're done with section 9, which is basically deemed income, but a very small section, section 8. Let's finish it because it's here. Guys, dividend you know now is taxable. Please tell me under which head will you tax dividend? Salary, house property, PGBP, capital gain or IFOS? It will always, dividend only has one direction, that's my shortcut. D for direction, only one direction, that is IFOS always. And in that case, guys, when will dividend be taxed? Today, 1st of March 2022, dividend is declared, which is the final dividend. But it's going to be received on the 4th of April 22. So which year will it be taxed? 21-22 or 22-23? This is the date of receipt. When will it be taxed? Guys, in case of final dividend, whenever it is declared FD. So it will be taxable in 21-22. But if the same thing is interim dividend, which is declared today but received in 4th April, interim dividend when received. So that is what section 8 talks about. Dividend taxation is discussed in detail under IFOS. Final dividend taxable in the year it is declared, but interim dividend is taxable in the year it is received. So this is FD. Remember FD, so you automatically remember IR. So final dividend when declared, because you cannot cancel it, but interim dividend can be cancelled, hence only once you receive it will it be taxable. Wow. In just about 50 minutes we managed to do this chapter. That's really, really good, guys. It's a very, very demanding chapter. Look at the amount of explanations that are needed for this chapter. Just have a look, guys. Perfect. Good job. And this will definitely get you marks in the exam. And we will apply this also. You know how we do it. So I'm just going to convert the PDF now quickly. And we'll also have a look at the questions from this chapter. This is residential status and scope of income. But guys, a 5-minute break for everyone before we enter into the world of questions. 5 minutes and we are back. Thank you. Alright, let's do this, guys. I am looking at the module of this chapter. So just putting it up before we can start solving. So here we go. Residential scope, status and scope of income is the chapter's name. Straight away going to the questions at the end. Here we are. Guys, Ram is an Indian citizen. Ram is an Indian citizen, left India on 22nd September 2021 for the first time to work as an officer of a company in Germany. Determine the residential status of Ram for the assessment year 22-23. So guys, before we start, let's at least calculate the number of days. I want you all to calculate and tell me till 22nd September how many days has he stayed in India. Yes guys, how many days stay in India? Till 22nd December, sorry, 22nd September. Nikita, try once again. I think there is a small mistake in your answer. Anyone guys, how many days stay in India? I have a lot of spectators who are watching this silently, guys. ICAI will also give you a very silent treatment in the exam, just the way you are giving it here. 175 days, yes. Now, basic condition 1, section 6(1). Stay in India greater than or equal to 182 days is not fulfilled. you go to basic condition 2. But guys, he's an Indian citizen who has left India for employment, so basic condition 2 will not apply. So this guy will become a non-resident for this year. Will any of the amendments apply here, guys? They've not given us any dear income, so amendments will not apply. So this person is a non-resident for this year. Here we go. He's a non-resident for the year. Perfect. Guys, next, Mr. Day, a non-resident residing in US since 1990, came back to India on 1st April 2020 for permanent settlement for the year 21-22. Guys, here, basic condition 1, is his stay greater than or equal to 182 days in the year? Yes. So he is definitely a resident. Now we have to, this question is basically on ROR or RNOR. So additional conditions we have to ask. Let's do this. Additional condition 1, in the last 10 years, preceding years, so that means not 21-22, but 20-21 and before, was he a resident in greater than or equal to 2 years? Let's check, guys. He came to India only on 1st April 2020, so no. And even if one of them is no, you know he's an RNOR. So this is section 6.6, this is section 6.1, this is your answer, RNOR. So here is your answer. He is a RNOR resident but not ordinary resident for the year. This is scope of income, guys. Mr. Ramesh and Mr. Suresh are brothers and they earned the following incomes during the financial year. Mr. Ramesh has been settled in Canada since the year 1996. So Ramesh is basically a non-resident and Suresh is basically a resident. First, let's calculate for Suresh. I think everything should be taxable, but still let's calculate. I'm giving you 2 minutes. He's a resident. These are 10 incomes with life insurance. Ignore this. 9 incomes. Please total it up and tell me what will be the taxability of Suresh, only of Suresh in India. Alright, guys, every income is taxable. 40,000 also, dividend also, profits also, short term also, income also, interest also, but agriculture income is not taxable. And rent received, guys, you've done IFHP. If you receive rent, you will only tax 70% of this. So 60,000 into 70%, only 42,000 will be taxable here. So that will be your answer for Ramesh. But very important for Suresh. Now for Ramesh, guys. Now for Ramesh. Everyone, this is more important. Let's do this. Good answers, Nikita. Alright, let's check this. As interest on Canada development bonds, 50% received in India, so 17,500. Dividend from British company received in London. Guys, these are non-residents, so only dear income. This is not dear. Profits from business in Nagpur, so this is dear. Short-term capital gain of shares in India, dear. Business in Chennai, dear. Fees for technical services rendered in India. Guys, the services are rendered in India, so dear. Interest on saving account, dear. Agriculture income is not taxed, and this 42,000 is taxed. This is Suresh and Ramesh. Good job with scope of income section 5. Guys, we haven't done 80C and hence 80TTA. We have not discussed these. So I'm only discussing these two. This is Ramesh, non-resident, and this is Suresh. Check your answers, guys. This is the answer. Perfect. Now going to the next question. Examine the correctness or otherwise income deemed to accrue arise in India is to be taxed irrespective of territorial nexus. Guys, this exact same question came in the exam for about 3-4 marks. Guys, whenever a non-resident earns interest, royalty or fees for technical services, do we have to check the territorial nexus? For Government of India, we don't have to check, but resident and non-resident, we have to check. It has to be used in India. Very interesting, guys. Over to you all. Question number 5. Examine whether the following transactions will be taxable in India in the hands of the recipients. First one, please read and answer. Taxable under section 913 ISS. Next one. Taxable under 915 ISSDI interest. Next one. Taxable, but out of 19,000, 3,500 is exempt. So how much will be taxable? 15,500 will be taxable. Under 1015 post office, 3,500 is exempt. Next. Not taxable. Why? Because it is royalty and you have to check usage. It is used outside India, so not taxable. 91 ISSDIR 916. And last one, paid in Delhi, so dear income, so taxable, received in India. Alright, also representing the case in India, this is fees for technical services rendered in India, taxable. Alright, any other question? Let's see, guys. Done and dusted. One more chapter down. Very, very happy to move ahead from this chapter. Perfect. Guys, we are looking at this chapter, which is completely done. I did not expect it to go so quick and so well. Now we are going to the next chapter, which is IFOS. Guys, once we finish all the chapters, it will be very interesting to see the MCQ booklet. It will also be very interesting to see how we apply the knowledge that we have in sums. But that reminds me to do rates of tax, guys. Rates of tax of individual is done. We did basic tax, rebate, surcharge, cess, etc. for individuals. Now for HUFs. I like HUFs because they're the same like individuals. Do they have for basic tax? Do they have a basic exemption limit? Yes, of 2,50,000. No higher limit? No. From 2.5 to 5 lakhs, it is at 5%, then at 20%, and then at 30%. Same as individuals, yes, same as individuals. So they have a basic exemption limit, basic tax. Surcharge, sorry, rebate they don't get. I'll just write it here only. Rebate you don't get. Why? Because HUFs don't vote, guys, so they don't get any rebate. Surcharge is the same, more than 50 lakh, more than 1 crore, more than 2 crore, more than 5 crore is the same. And HEC is also the same. HEC is always 4% of what? Guys, it is basic tax plus surcharge, if any. On that there is HEC, that is 4%. This is basic tax, surcharge and cess for HUFs. Very similar to individuals, yes, very similar to individuals. Alright. Now we move to the next chapter, which is, guys, basic concepts is done, residential status is done, scope of income is done, agriculture income is done, exempt income is done, IFHP is done, IFOS is the next chapter. This chapter is amazing because this chapter sets the stage up. Just one second. This chapter sets the stage for PGBP, and hence I particularly like this chapter. What we are going to do now is we are going to do a chapter and then a smaller chapter. So one IFOS, and then we'll do clubbing, and then PGBP, and then we'll do set off, and then capital gain. So we'll do a yin and yang, a seesaw between a big chapter or a head of income and a smaller chapter. Perfect. Nikita remembers the shortcuts well. Good job, Nikita. Guys, IFOS is the next chapter here. IFOS. Guys, this is the last head of income, but we are doing it as a second because I like this pattern of going ahead. So this is section 56, which has different incomes. Then there are section 57, which has different expenses. and this will give you your IFOS, yes. And then there is section 58, which basically talk about disallowances. That means those pizzas which you pay for but they don't reach your home, you feel very bad because they are disallowed. And section 59 is a very tiny section for deemed income. Here also we'll see what this is. But IFOS has three parts to it, guys. One of them is this. The other part is dividend taxation. And then there is one more part of gift taxation. So basically we need to do all three parts and we need to do it well. I'm going to start with gift taxation, go to dividend and then go to this. That is the pattern that I'll follow. I just need 1 minute to gather and then we will continue in a minute, please. Alright, let's do this. Guys, IFOS is where we are. First, gift taxation. Guys, gift taxation is very important at CA interlevel. Gifts are never to be seen from who's giving it. Gifts are always to be seen from who's receiving it. So this is the person who's receiving it. In our example, it was Miss B's birthday party. If you remember, there was a Miss called Miss B and she was celebrating her birthday. She got a lot of gifts, but someone told her that gifts are subject to tax, that is called gift taxation, and she was sad about it. So Miss B, the jaw became sad, sad jaw. But then they told her that not all gifts are taxable, only some gifts are taxable. So for that, they informed her about 3 steps to be followed. This is step 1. A gift will be taxed only and only if they fall under the definition of property. So what is the definition of property? It is MISB sad jaw. What is MISB sad jaw? Let's try and define it. Money, immovable property, securities. Money is money. Immovable property is a house, land, office, etc. Securities are shares, bonds, debentures. Any bullion is precious metal. Any sculptures, archaeological collection, any drawings, like not your drawing, not doodle guys, but your famous drawings. Jewelry, artwork, and any other work of art. Mainly here is jewelry, and mainly here it's all these four. This is property. So if someone gives you a mobile phone, a laptop, a pen, a coffee mug, etc., all these are not subject to gift tax, because only in the definition of property. So if in the exam they say someone gifted you a motor car, thank you so much, but no gift taxation, because not in the definition of property. Next, step 2. Only if it goes through step 1 will it go through step 2. Step 2 are certain situations, and if you are one of those situations, there will be no gift tax. So step 1 you have to fulfill. Step 2 you don't have to fulfill. What are the situations? Please be very careful. The shortcut is, I'll show it to you here. The shortcut is, don't tax tip and money received from LAHUF. Guys, what is this? Don't tax tip and money received from LAHUF if received on the death of a person. If someone expired and they give you a property, then in that case you will not be, always from your perspective, you will not be subject to gift tax. Next, T and T. Tip is T and tax is T. If you get money from a trust, example, some charitable trust has given you money to do studies, some charitable trust has given you money to do to complete your operation, so that is not exempt. And when you give property to a private family trust for the benefit of your family members, so trust and trust, that is also not taxable. Next, ITIP. So I, if you inherit some money from some grandfather or some father or mother, etc., if you inherit, on inheritance there is no tax. P is if persons that are specified by the government, on that there is no tax. Example, if you are a slum dweller and you are getting a nice apartment in a building in exchange for your slum, so you are getting a building apartment, in that case you are getting a gift which is a property, but because the government has notified you, you will not be taxed. A very happy moment, marriage, on that day if you give whatever property as gift, MISB sat jaw, that is not taxable, provided someone gives you MISB sat jaw and provided not everyone gives you mixer grinders. So in that case you will, if you get property, you will not be taxed. So all the money that people get on a marriage, that is all not taxed. Next, R, if you get it from your relatives. Guys, here there are 232 relatives. It's just a joke, because this is a shortcut to understand relatives under IFOS. Next is F. F is basically from LAHUF. F is basically a fund, like a charitable fund, etc. LA is like a local authority, and from the HUF if you get something, in all these cases you as a recipient will not be taxed. So I'm repeating, don't tax tip and money received from LAHUF. Death, from a trust to a family trust, inheritance, persons who are specified, marriage, from relatives, 232 which we will see, from a fund, from a local authority, and from an HUF. In all these cases you are the recipient. Congratulations, you will not be taxed. So step 1 is property and step 2 is these situations. Now let's see what is 232 relatives. So in 232 relatives, I'll just define here what is 232 relatives. 232, two spouses, which kind of sounds funny, but there's a logic to it. 3 brothers and sisters, and 2 LAs, lineal ascendants and lineal descendants. What is this? Let me explain. Guys, this is you, and they want to basically find out who are your relatives. Let's start. Your spouse, that is one spouse down. Your brother and sisters, your spouse's brother and sisters, and your parents' brother and sisters. So that is 3 brother and sisters down. So 1, 2, 3 down. I'll just write it slightly better. 2 spouses, 3 brothers and sisters, and 2 L is lineal ascendants and lineal descendants. 1 spouse is done till now, your spouse. 3 brother and sisters are all done, your brother and sisters, your spouse's brother and sisters, and your parents' brother and sisters. So 3 brother and sisters done. Your LAs and LDs, that means local lineal ascendants, that means your parents and grandparents and above, and your lineal descendants, your children, your grandchildren, etc. Same thing for your spouses also. So 2 LA means your lineal ascendants and descendants, and even your spouse's parents and grandparents are your relatives. We are seeing everything from your perspective, guys. And last, what is the last spouse left? All these people who are mentioned here, they are spouses. So your brother, his spouse, your sister, her spouse, your child, his or her spouse, so everyone who's mentioned here, their spouses are also included in the definition, because it's a very wide definition, the widest that we've seen in terms of relatives definition, 232. Alright. So these are the 2 situations, step 1 and step 2. Step 1, if it's property only, then you will go to step 2, and if it's one of those situations, then you will not be taxed. So now we go to step number 3. In step number 3, the gifts will be categorized into 3 categories. One is money. So all the money that you get, cash, check, DDs, etc. All the movable property like your jewelry, like your shares, etc. And all the immovable property like your land, house, etc. will be categorized into 3 categories. If the aggregate money is greater than 50,000 in a year, then fully taxable. So if lots of people have given you gifts, more than 50,000 is aggregating not individual, in a year, then it's fully taxable. Same with movable property. If the aggregate fair market value of all the shares, all the gold, etc. is greater than 50,000 in a year, then it is fully taxable, not the excess, fully taxable, think like the government. And immovable property, if individual value is greater than 50,000, then the entire thing will be taxable. What value? Stamp duty value here, fair market value here, and money value here. This is aggregate, but this is an exception, this is individual. How do you remember? Immovable property are very expensive, so individual, the other 2 are aggregate. So step 1, step 2 and step 3, and that's when you realize whether it is gift supposed to be taxed or not. Just 1 second. These are the 3 steps for gift taxation. Gifts are free and this is gift taxation. Just 1 second. Next, but there are some times where gifts are not free, but there is some benefit. Let me explain what I am talking about. As we'll also read from the quick book, everything is there in the quick book. There are some times you get some benefit. Example, let's say you are the surgeon's wife and you have gone to a construction company and you have bought a house which is stamp duty value 1 crore and you bought it only for sale consideration 75 lakhs. Are you going to be happy today? Very happy, because you got a 1 crore house for 75 lakhs. So what is the benefit to you? The benefit is 25 lakhs. Guys, no one gives such a huge benefit. Actually, it is you paying black money. Same way, so stamp duty value, which date stamp duty value will you take? You generally take date of registration, but if in the exam they give you 2 stamp duty values, date of registration 1 crore and date of agreement, let's say 80 lakhs, and you want to take date of agreement, can you take that? You may take that, and you want to take that because lower is beneficial. So you may take that if guys, only one thing, you may take that if some amount of money has been paid on or before date of agreement by modes other than cash. I'll repeat. Guys, this is also gift tax, but it's not a free gift, it's a benefit. So here you're getting a stamp duty value of 1 crore house for sale consideration 75 lakh. So it's a benefit of 25 lakh. This I've understood, I've considered stamp duty value as 1 crore, but what if the exam gives you 2 stamp duty values, then you may take the lower one, which is rate of agreement value generally, if some amount of payment has been made other than cash, etc. What is cash? Cash is not allowed, no. Cross check, no. Cross demand draft, no. Bearer check, bearer demand draft, no. So cross is a no, you're not allowed. Account pay is okay. Cross check is not allowed, bearer check is not allowed, cash is not allowed. And guys, if you go to a jeweler and if you buy a ring worth fair market value 10 lakhs and you are saying you bought it only for 3 lakhs, again, are you happy because you're getting a benefit? Yes. What is the benefit here? 7 lakhs. But no one gives you such a huge benefit. You paid black money. So in both these situations, you paid black money. The government knows that, and hence the government says that, listen, step 1, only if the benefit is in the nature of property. Is this property, guys? Yes, this is a house. Is this property? Yes, this is jewelry. Same MISB SAT job. So same, yes. Then step number 2, it should not be in one of the situations, and step number 3 is, so step 1, step 2 same, step 3 slight difference. Money category is not there because you never get benefit in terms of money, guys. I have never exchanged a 2000 rupee note for 3000 rupees, no. So money is never a category. Movable property, not the aggregate, here also aggregate, but not the fair market value, the aggregate benefit. If the aggregate benefit is greater than 50k, taxable. So is the aggregate benefit, which of these is mobile property? Jewelry, guys, is mobile property. So here the jewelry, what is the aggregate benefit? 7 lakhs. So is it more than 50,000? Taxable. And for immobile property, the individual benefit should be greater than higher of the following two amounts. A, 50,000 is still there, but they have also included another B amount, which is 10% of the sale consideration. So 50,000 is okay. What is 10% of sale consideration? How much were you buying that apartment for? 75 lakhs. So 10% of that, that is 7.5 lakh. 50,000 or 7.5 lakh, whichever is higher, 7.5 lakh. So guys, that what does the government mean? The government says, listen, it's okay to bargain. You are an Indian, we are born to bargain well. We always bargain well, it's okay to bargain, but up to 50,000 here if you bargain, no problem, and up to 10% of sale consideration up to 50,000, whichever is higher if you bargain, no problem, we will not tax you. But if the benefit is even more than that, that means such a big bargain, how could you get? You've definitely paid back money. So in that case, if the benefit is greater than any of these higher of the two, then you will be taxed. So here the benefit is 25 lakh. Higher of the two is 7.5 lakhs. Is it more than 7.5 lakhs? Yes, so the entire 25 lakh will be taxable. Perfect. So here we go. Just recapping, gift taxation. Gift taxation is of two kinds. One is free gifts and one is benefit taxation. Free gift, step 1, it should be in the definition of property. Step 2, it should not be one of the situations, don't tax tip and money received from LAHUF. And step 3, the aggregate money, aggregate mobile property should be more than 50,000 and individual stamp duty value should be more than 50,000. Then the entire thing will be taxed, yes. And benefit taxation, there is a step 0 also where you calculate the benefit. And then step 1 is the same, step 2 is the same, step 3 money is not there, mobile more than 50,000 benefit, yes. And immobile, there is a small change, more than 50,000 or 10% of sale consideration, whichever is higher. Alright, this one guys, I'm just showing it to you here. Gift taxation, step 1 is this, property. Step 2 is this, these situations are discussed here. Step 3 is this, but this is benefit taxation. Again, step 1, step 2 are the same. Step 3 is higher of 50,000 or 10% of sale consideration. In case more than one stamp duty value is taken, then you may take stamp duty values in the rate of agreement, may be taken if some amount has been paid other than cash, cross check or bearer check. Guys, this we'll discuss ahead when we discuss amendments. It's a small change, we'll discuss it. Guys, MISB SATJOT doesn't all involve stock. So if I'm a jeweler and I've got jewelry at a lower value, will I do benefit taxation? No. Why? Because that is my stock, that will be covered in PGBP. 232 relatives, and these are the illustrations. That's your gift taxation. Now guys, we move to dividend taxation. Guys, if you all ever need a break, we've taken one recently, but if we ever need a break, you can signal it to me. I will not understand it, so you will have to tell me and we can take it whenever you all want one. But right now we are at dividend taxation. Guys, I told you we have about 14-15 chapters. We have 24 hours into 60 minutes, 1440. 24 hours do we have? Yes. Divide by 15 chapters. So we get about 1.5 hours for one chapter. How many chapters are we done? Residential status 1, introduction 1, agriculture exempt income 1, house property 1, and yes. So we are done with 4 chapters. Perfect. So we are on track. In fact, we are very well on track. So there is no problem. Perfect. Let's move. Dividend taxation, guys, is a very interesting concept. Dividend is now taxed from the 1st of April 2020. Dividend is now taxed by the person who's receiving it. Obviously, dividend is only received from a company by shareholders. So whether you are receiving it from Reliance or whether you're receiving it from Tesla, whatever dividend you receive will be taxed. You know, final dividend when declared, interim dividend when received. And dividend is only taxed in one direction. Dividend is always taxed under IFOS. Guys, to earn dividend, you don't do too much, so there's not too much of income expense to earn that dividend income. We'll see in the expense in section 57. Now guys, a lot of Indian companies were manipulating this. What were Indian companies doing? Indian companies were establishing specified foreign companies, or they were basically establishing companies abroad in which they had a lot of stake, 26% or more. So an Indian company establishes a foreign company, specified foreign company. Specified foreign company basically means a company in which you have 26% or more shareholding. And in this foreign company, because they had so much of shareholding, they would influence the foreign company, and the foreign company had a lot of money, but the foreign company would not declare dividend. If they would not declare dividend, it would not come into India, and Indian government would not get the right to tax it. So this was happening on a very big scale, and hence the government told the Indian company that, Indian company, can you please bring back this dividend? Indian company says, why should I bring back this dividend? You will tax me, and Indian company's tax rate is 30%. So they said, don't worry, we'll tax you only at 15% under a section called 115 BBD. Guys, I'm repeating, 115 BBD is bring back dividend. Applies only to Indian companies, not to you, not to me, only to Indian companies when they have 26% or more in a specified foreign company. And when they get the dividend into India, if they get it, it will be taxed at only 15% under 115 BBD. Will they get any other expenses after this or for this? No other expenses, because we are anyways taxing you at a very low rate. So this is 115 BBD, bring back dividend at the rate of 15%, we will tax you. Alright, next. Guys, who wants to pay tax? Especially if the company has already paid tax. If your company has already paid tax and now they have profit, so this is a company which has already paid tax and it has 222 lakhs now. But they know that when they are given, this money is given to the shareholders as dividend, it will be taxed again. And who wants to pay that tax? So people in India came up with very fancy ways to remove money from the company. The first way was the company gave away assets. Example, instead of giving out money and calling it dividend, they gave gold coins to the shareholders and they said, listen, this is not dividend, this is gold coin, and they told the government you can't tax it because it's an asset, it's not dividend. The government says, listen, all these tricks I know already. This asset that you've distributed, it is actually deemed dividend. In the Indian government, in the Income Tax Act, they introduced a section called Section 222, deemed dividend, which is very, very simple. Guys, dividend directly is taxable. So indirectly, people are trying to remove money from the company. So the government says under 222A, if you remove assets or if you distribute assets by a company to its shareholders, then it will be taxable under 222A. Who will pay the tax? Again, the shareholders only, yes. Next, if instead of assets, what your issue is, you issue bonds, you issue debentures, you issue preference shares, so that right now what you are issuing are only pieces of paper, but in 6 months, 1 year, etc., the company will pay money and the money will go out indirectly. So the government says, we know this also. So 222B, if you are issuing bonds, debentures, preference shares, this is also deemed dividend. Unless it's equity shares, then we have no problem, because on equity shares the company does not have to pay after a while. So equity shares is no problem. So these bonds, debentures, preference shares, if given as bonus free of cost, then it will also be deemed dividend. So next, what the company does, they shut down the company, they close the company, and when you shut down the company, what do? You close the company and you distribute the assets to the shareholders. But why is a profitable company shutting down? They can always start a new company the next day. But the government says this also, we know. 222C, close. If you liquidate the company and you distribute assets, this is also deemed dividend. This is also something that we know. Again, all these deemed dividend will be taxable in the hands of the shareholders, yes. And last in this series is 222D, where you try and decrease the share capital. The share is for 100 rupees, you decrease it to 1 rupee and you pay 99 rupees to the shareholders. The government says, listen, we know all these tricks also. So 222D, D is decrease in share capital or reduction in share capital. In that case also, it will be deemed dividend. So guys, are these indirect ways of removing money from a company without calling them dividend? Yes. But is the government catching them and telling them that this is deemed dividend? Yes. Is it taxable? Yes. Who's going to pay the tax? The shareholders again are going to pay the tax. Same thing. Yes, you are caught. But here, you will be taxed only if the company has profit. So, will you be taxed under 222A, B, C, D? Yes, but only to the extent of accumulated profits. What if the company is like Air India, only makes losses, PhD in making losses? Then no, then there is no deemed dividend. But if the company has profits, accumulated profits, whether capitalized or not doesn't matter, guys. But up to the extent of accumulated profits, only that. So if you distributed 300 lakhs, then only up to 222 lakhs will it be taxable. This is deemed dividend 222A, B, C, D. All the plans failed of removing money, so you made a master plan which is on this side here. You told the company that don't give me assets, don't give me bonds, all these are caught, simply give me a loan. You have 222 lakhs, use that money and give me a loan. Who will come to know whether I repay you the loan or not? This one is only applicable to closely held companies. So the company gives a loan and the loan is not given to any shareholder but a beneficial interest holder. You know beneficial interest holder, someone who holds 10% or more in the company. So this is only applicable to closely held companies when the loan is given to a beneficial interest holder. So now the government said that this is the most extreme step which we have caught. So 222E, E is the most extreme step. So this loan will also be considered as deemed dividend, yes. Up to the extent of accumulated profits, yes, but only the sum which is not capitalized. So there are some differences. This one only applies to closely held companies. These apply to all companies. This one only applies on a loan. This one applies the earlier one on assets, etc. This is only to a beneficial interest holder. This one only to accumulated profits which are not capitalized. CHC means private company. Yes, private companies and some other companies, but for your exam purpose, you can think of closely held companies as private companies. So guys, this is also caught. So why don't you do one thing? Instead of giving directly a loan to a beneficial interest holder, why don't you give a loan to an entity in which the beneficial interest holder has substantial interest, that is 20% or more substantial interest, then indirectly the money can go to the beneficial interest holder. So even this is caught. Yes, directly giving a loan is also caught. Indirectly giving a loan is also caught. Indirectly means giving it to an entity in which the beneficial interest holder has substantial interest. Guys, beneficial interest holder is common. Yes, he has substantial interest in the entity. Example, there's a partnership firm in which you have 20% or more profit sharing ratio. Or third, you give it to a third party for the benefit of the beneficial interest holder again. So in the exam they will be saying that you gave a loan, the company gave a loan to a third party for the benefit of beneficial interest holder. In all these three cases, will it be deemed dividend? Yes. Guys, this does not apply to banking and finance companies because it's their job to lend money, so we don't stop them. So it does not apply to banking and finance companies. And if you repay the loan, does it matter? No, repayment of the loan does not matter. If you pay interest on the loan, does it matter? No. Whether it's a genuine loan or not a genuine loan does not matter. Repayment, interest does not matter. And what if after this is considered as deemed dividend, let's say 222 lakhs is already considered as deemed dividend, after that actually dividend has declared, then you won't tax it again, guys. If once you've tackled it as deemed dividend, the loan, and then after that you actually get dividend, then up to the 222 lakhs or up to whatever has been taxed already, you will not tax it again. I repeat this, section 222E. E is the most extreme step. What is the extreme step? A company which has profits is giving out loans to either the beneficial interest holder directly or to an entity in which the beneficial interest holder has substantial interest indirectly, or to a third party for the benefit of the beneficial interest holder. So in all these three situations, will it be taxed as deemed dividend? Yes. In the hands of whom? Obviously the person who's getting the money. Only for closely held companies, yes, not for banking finance companies, only up to the extent of accumulated profit which is not capitalized, and even if you repay the loan, even if you pay interest, does not matter. And last, if the company actually declares dividend. As deemed dividend, 222 lakhs is taxed, and now dividend 200 lakhs is paid actually, will it be taxed again? No. But what if 225 lakhs is paid as dividend, then only 3 lakhs will be taxable, only the excess will be taxable. That is section 222E, A, B, C, D. So we are almost done with dividend taxation. Let's read. Dividend is now taxable in the hands of the shareholders from 1/4/2020. Dividend has only one direction, always IFOS. Final dividend, interim dividend. 222A, assets. B, bonds, debentures. C, closure of the company. D, reduction, and E is the most extreme measure, that is loan and advance. But remember guys, there's one way to get money out even after all of this. I'll tell you a way how to get money out even after all of this. You can simply say that I'm not taking a loan from the company, I'm taking a business advance for the purpose of business, and you take the money out. Not the most legal thing, but a lot of people do that. They take out money from the company by saying it's a business advance, and they show a necessity for business, and that's how they remove money from the company. However, trade advance is not to be treated as deemed dividend, so trade advance or business advance can be taken. Beneficial interest holds 10% or more. 115 BBD is something that only applies to Indian companies. Alright. And with that guys, we've completed dividend taxation also. So we've completed gift tax, we've completed dividend tax. Now is general IFOS with sums. We will take a 5-minute break here. We will come back and we will continue with the general part of IFOS, and then we will also do sums from IFOS in 5 minutes from now. Thank you so much. Alright, we are back and IFOS is on the cards guys. Almost done with IFOS. All we now need to do is complete the basics of IFOS and then look at questions from the module. Guys, while gift taxation and dividend taxation is wrapped up, now we're looking at the general part of IFOS. Here we go. The general part is section 56. There are some incomes which are taxable only under IFOS, and there are some which are dustbin section. If they are not taxed in any other head, can we put them here? Yes, this is a residual section. That means if there is any income which is not taxable in salaries, house property, PGBP, capital gain, but the government of course doesn't want to leave it, so it's taxable here, residual income. And in 56(2) there are some specific incomes which are taxable under IFOS. Which are those specific incomes? You never have to by heart it, because there is a shortcut to by heart that. 56(2), in retirement/death, I will receive some welfare gifts from insurance contracts. So these are indications of what is there in 56(2). First is interest from securities, etc. will be taxable here. But if you are Rakesh Junjunwala and that is your business, then you can also go to PGBP. Next is rental. But rental of what? Rental of spare idle capacity. Example, you have extra computers, extra furniture, you can rent it out, but that's not your business, so it's your. If it's your business, then PGBP. Next, D is dividend. In retirement/death, dividend is always and always going to be taxed under IFOS. It has only one direction. Next, I is again interest, but this is interest on enhanced compensation. Now, what is enhanced compensation, guys? Whenever the government compulsorily acquires your asset, whether it's your house or your land or whatever it is, sometimes they pay you, but they pay you delayed. Or sometimes they don't pay you enough, so you fight in the court and then they pay you more. So in both these cases, they will pay you interest. You will tax it here, and by the way, you get a 50% reduction on this in 57 section. Why the reduction? Because you get a lump sum. Guys, this interest is taxed only on receipt basis, and hence whenever you receive it, even of 4-5 years interest together you receive, it will be taxed on receipt basis, and hence the government gives you a 50% reduction because they're taxing you in 1 year. Next, welfare amounts, winnings. Winnings from lotteries, betting, gambling, KBC. Guys, whenever you win from any of these, remember, you've gotten lucky, the government also wants to get lucky. What does that mean? They do not allow any reduction of any expenditure. They do not allow any deductions of any expenditure, no slab rates, no rebate, not even a basic exemption limit you can take. In these cases, you can't even take the basic exemption limit. So this is the concept of winnings. Next is R, rental income again, but this is composite rent, which we have already discussed in house with furniture. That composite rent will come here. Next is shares. This is, guys, very important, section 56(2)(7)(b). I have given Byju's example because it is B. Guys, if you are a closely held company, do it from here only. If you are a closely held company and you issue shares, then, and if you are issuing shares at a premium, just 1 second. If you are a closely held company and you are issuing shares at a premium, then the government says, listen, we want to tax you. But how can they tax issuance of shares? That's a capital receipt. Hence the government introduced a new section to tax this. Very, very greedy of the government. They say this is only for closely held companies. If a closely held companies like Byju's issue shares, then you will have to check first step if the shares are issued at a premium. Premium means the shares are issued for more than the face value. If the face value is 100 and you've issued the shares for 150, then is it at a premium? Yes. Just 1 second. Are they issued at a premium? Yes, they are issued at a premium. That's the first step. And second step, if they are issued at a premium, only then you go to the second step. Second step is how much have you issued them and what is the fair market value. If the fair market value is 120 and you issued them, issue price is 150, then on the extra 30 rupees you've got money, so the government wants to tax you under IFOS. Yes. So again, guys, whom does it apply to? This applies only to closely held company. The section is 56(2)(7)(b). 7B is for Byju. Closely held company issuing shares, first step, they should be at a premium. Second step, it should be more than the fair market value. Only if it's more than the fair market value. In the first step, you compare the issue price with the face value. And the second step, you compare the issue price with the fair market value. Only if it's higher than the fair market value, that difference will be taxable under 56(2)(7)(b). Next, in retirement/death, I will receive some welfare amounts. Guys, if you have employees in IFOS, can you have employees in IFOS income also? Yes, for securities dividend, you can have employees. And if they are contributing to their provident fund, etc., the slave, I'm talking about the employees. If the employees are contributing, they are giving you, let's say this is you, the employer, and this is the employee, and they give you money that, listen, can you pay to my PF, can you pay into my NPS, can you pay into my funds? You need to pay within monthly due dates. If you don't, then that amount will be added to your income, welfare amounts, and you will not get a deduction. That's a punishment, yes. That encourages you or pushes you to pay within due dates, because first it will be added to your income, and only if you pay within monthly due dates will it be allowed to be minused. So if your employee pays 50,000 rupees to you so that you contribute to a fund, employee fund, welfare fund, then that 50,000 will first be added, and only if you pay within monthly due dates will it be allowed to be minused. Next, gift taxation, we've already seen. By the way, guys, gift taxation section is 56 to 10 because you always want to receive 10 gifts. From is forfeiture, guys, on or after 1st April 2014. If there is any forfeiture means someone has paid you some money. Let's say they want to buy a house and they paid you some money, 10 lakh rupees, 51,000 rupees, whatever is the amount. And then they are unable to complete the deal. So that amount gets forfeited. That's your benefit. So it will be taxed. Yes, it will be taxed. Any money from insurance contracts, but they are not normal insurance. This is keyman insurance. Keyman insurance is taken for important people in an organization. And when the company gets money, it's taxable under PGBP. When the family gets money, it's taxable under IFOS. And when the employee itself gets money, it's taxable under salaries. That means, guys, keyman insurance, is it life insurance? Yes, but it is always and always taxable. And last is any non-business contract. Example, you had you for investment purposes, you had a demat account with Sher Khan and they made some mistake and they compensated you with some money. So any non-business contract, any modification, termination, and you get some money, that is taxable under 56(2). Yes. So 56(1) is residual. 56(2) is specific incomes. In retirement/death, I will receive interest, rental, dividend, again interest on enhanced compensation, winnings from lotteries, rental again, closely held company shares, welfare amounts, gifts, forfeiture, keyman insurance, and termination of non-business contracts. But these are incomes. Just like you tax your incomes, can you also minus certain expenses? Yes, the expenses are under section 57. The shortcut is will, repair, pick in general. Here it is. Will, repair, pick in general. Any welfare amounts which we just added, if you pay within monthly due dates, you can minus. Yes. Next, any repair of the idle capacity, plant and machinery, furniture which you've rented out, any repairs, depreciation, maintenance, insurance, you can minus. Yes. If you are getting family pension, guys, pension, if employee gets it, it's taxable under salaries. But if the family gets it, it's taxable under IFOS called family pension. But because the government feels bad, because family pension is when the person is no more, the family gets pension, the pension is deductible. And what is the deduction? 1/3 of the amount or 15,000 per month, whichever is lower, that's the deduction for family pension. Next is interest on enhanced compensation. You get a 50% deduction. For buying securities, if you have any charges or commissions, that you get a deduction. Next, to earn dividend, you bought shares with loaned amount on which you paid interest. Example, you bought some shares on loaned amount and you got some dividend. Dividend is income, but is the interest expense? Yes, but maximum 20% of dividend income. And last, any general expenses. Guys, link the expenses to the incomes. Welfare amounts to the welfare amounts above. Repairs, insurance, depreciation to renting of idle capacity above. Pension to family pension above, which is generally family pension is taxable. Interest on enhanced compensation above 50%. Interest on securities, commission and charges to buy such securities, and dividend income is taxable. The interest on the loan to buy such shares up to maximum 20% of dividend income only, and any other general expenses. And last thing, guys, while this is taxable, is there something which is disallowed? Yes, section 58 says that the following incomes will be disallowed, following expenses will be disallowed. That means, do you incur those expenses? Yes, but the government does not give you the reduction. Yes. Poor wins cash income. To earn the IFOS, after you earn the IFOS, did you pay income tax? Yes, that will not be allowed as a reduction, because income tax is not to earn the income, it's an after effect. Poor wins cash, any cash expenditure above 10,000 per person per day. Guys, cash is allowed if you pay up to 10,000. 9,000 is okay, 9,500 is okay, 10,000 is okay, but 11,000 is not okay. From winnings, any deduction is disallowed. If you are paying excessive or unreasonable to relatives, your relatives is not 232, it's a simple definition of relatives. You, your spouse, your brother and sister, your LA and LD, that's it. That means your spouse, obviously, your brother and sisters, your LA and LD. Next, personal expenses are disallowed, guys. It's a personal expense, golden rule. If it's a personal expense, why are you minusing in IFOS or PGBP? And last, if you are making a payment outside India or to a non-resident. If you are making a salary payment outside India or to a non-resident, or if you are making a payment to a resident in India, in all these three cases, if you are supposed to deduct TDS and you don't deduct it, or you but deduct it but you don't pay it to the government, then the government gets angry and they disallow it. How much will they disallow? Outside India or to a non-resident, 100% is disallowed. And in India, 30% will be disallowed. Guys, this is not a permanent disallowance. So imagine today on the 1st of March you paid someone and you did not deduct it, or you did not pay it, then this year it will be disallowed, but whenever you pay it, it will be allowed in the year of payment. Yes. And one exception, in all these three cases, if the recipients, they include in their income, they file their return and they pay the tax, the government has got the tax. Even if you did not deduct the TDS, the government got the tax. So in that case, whenever they file their return in that year, you will get the deduction if it is disallowed. Again, in this, what is the main thing? Cash payment is main. Winnings also, you don't have any deductions. And this TDS is main. All these will also come ahead in PGBP. Guys, this is 50% deduction on interest and enhanced compensation. This is BYJU'S step 1 and step 2. And this is gift taxation. This is your chapter IFOS. Remember always that whenever you have incomes, in relation to that, expenses will be allowed always. And remember, if you pay cash, don't deduct TDS, pay personal expenses, pay all that is disallowed here also, and ahead in IFPGBP as well. Now it's that time, guys, where we look at questions. I'm just going to convert it into PDF and then start doing the questions. Here we go. Just give me a minute. Perfect, guys. While I upload the IFOS thing, this is the last thing that we'll do today, and then we'll not start anything new. If you have any questions, we can discuss it. Otherwise, this is the last chapter that we will do today. Perfect. Here we go. Here are the questions, guys. Let's do this. Test your knowledge. So why don't we test our knowledge, guys? Examine under which heads the following incomes are taxable. Some of them you might be know, some you might not know because we haven't done all the heads. The first one, rental income for a property which has been held as stock in trade for 3 years. Guys, here the property means house property. If you have constructed it after 2 years, will they have deemed that out? Yes, this is house property. But this is not clear. This kind of question will not come in the exam. Dividend on shares in case of a dealer in shares. Guys, your Rakesh Junjunwala, where will dividend go? Always IFOS. Whether you're Rakesh Junjunwala or you're a student or you're me, everyone IFOS. Salary received by a partner from a partnership firm. We haven't done this, but because you won't have done PGBP, salary by a partner to a salary received by a partner from a partnership firm is PGBP. That's an exception from salaries. Rental income of machinery. If it's a business, then PGBP. Otherwise, IFOS. Winnings from lotteries is IFOS. Remember, no deductions allowed. Salaries payable to a member of parliament. As this is also an exception. When member of parliaments get salary, they don't like to be called employees and taxed under salary, so they are taxed under IFOS. These are two exceptions to salaries. Salaries of partners PGBP and salaries of MPs is IFOS. Receipts without consideration, that means you've got something without paying, that is gift taxation, IFOS. In case of retirement, this we don't know yet because we've not done salary. Rental income in case a person is engaged in the business of letting out properties, PGBP. The moment there is business word, you know it is PGBP. Alright guys, here we go. Examine whether the following are chargeable to tax and the amount liable to tax. A sum of 1,20,000 received as gift from non-relatives by Raj on the occasion of marriage. Guys, will it be taxed? No, because it's on marriage under section 56 to 10, marriage is not taxable. Next, interest on enhanced compensation 96,000 received in this year for acquisition of urban land, of which 40% relates to the earlier year. Doesn't matter which year it relates to. Whenever you received it, you will tax it, but you will give a 50% deduction. So you will tax only 48,000. Next, Govind is a bank employee who received 5 lakh towards interest on enhanced compensation from the state government in respect of compulsory acquisition of his land in many years back. The interest of 5 lakh is broken up into different years, but doesn't matter guys. Whatever years, it will be taxed in the year of receipt. So 5 lakh will be taxed in the year 21-22 and he will get a flat 50% deduction. Yes. He incurred legal expenses. Unfortunately, that is not allowed as a deduction. Flat 50%, everything is included in that. Going to the next question guys, here we go. Question number 4. The following details have been furnished by Mrs. Himali pertaining to the year 21-22. Guys, over to you all. The first one, cash gift. Guys, cash gift step 1, is it MISB SATJO? Yes, it is MISB SATJO because it's money. Step 2, is it because of any of those reasons don't tax it? No. Step 3, is it more than 50,000? Yes, so taxable. Next one guys. Diamond necklace, step 1, MISB SATJO? Yes. Step 2, is it from a relative? Sister is a relative? Yes, so hence not taxable. And last one, guys, daughter was getting married and she got a gift of 52,000. So it's not her marriage, so hence it will be taxable, and it's more than 50,000. Perfect. Guys, looking at the next one. Examine the following transactions, as we will only look at it from the receiver's perspective because we have not done capital gain yet. So Mr. B transferred, so this is B, or have transferred some shares to a company called B Private Limited. How many shares? 500 shares for 3 lakh. So what is the sale consideration? For 3 lakh you've transferred. When the market price was 5 lakhs, so what is the fair market value? 5 lakhs. The index cost of acquisition of the shares was 4 lakh 45. The transfer was not subject to STT. Guys, from whose perspective will you see gift taxation? The giver's perspective or the receiver's perspective? Always the receiver's perspective. First, are they getting a benefit, guys, here? Yes. 5 lakh rupees shares, you will always take FMV, not index cost of acquisition. This is not capital gain. So from the receiver's perspective, the benefit is of 2 lakhs. Step 1, is it MISB side job? Yes, they are shares. Step 2 is not there. Step 3, is it money? No, it is mobile property. And is the aggregate benefit greater than 50,000? Yes. So the entire 2 lakh will be taxable in the hands of PPL, P Company Private Limited. So B Company Private Limited will be taxed under 56(2)(10) for 2 lakh rupees. We can't say from the giver's perspective because we haven't done capital gain. Next, C is employed with a company and has a salary of 5 lakh. He received a cash gift of 1 lakh from Atma Charitable Trust for meeting his medical expenses. Is the cash gift so received chargeable to tax? Step 1, is it MISB Satjo? Yes, it is money. Step 2, is it received from don't tax tip and money received? Yes, it's received from a trust. It's a registered trust and hence this is not taxable. Excellent answer. Wow. And that brings us to the end of this chapter. Guys, super job for day 1. We have time honestly, but I'm not honestly up for doing too much on one day because we need to do very steady progress. So before we end the session, let's do some rates of tax. So we've done how many chapters? Let's keep a count. 1 chapter down, 2 chapters down, 3, 4 and 5 chapters down in 6 hours. So 6 into 60 divide by 5. So we've taken roughly about 70 minutes per chapter, which is not bad considering we're also doing rates of tax and questions. And we've not even completed the 60 minutes. Just doing some rates of tax before we end. Guys, rates of tax of HUF is done. So now I'm just going to slide in and I'm going to add some more rates of tax. Just 2 more before we end. Guys, rates of tax of partnership firm. Basic tax, they don't have any slab rates. So flat tax of what percent? 30%. Whether the partnership on 100 rupees or 100 crores, they will pay flat at 30%. Is there any rebate? No, they don't vote, so they don't get any rebate. Is there any surcharge? Yes, a very simple surcharge. If the total income exceeds 1 crore rupees, then surcharge is at the rate of 12%. And is there any HEC? Yes, there is a HEC or 4%. That is the HEC. This is on the partnership firm. Also same with LLP. Very simple. Yes, very simple, nice, neat and clean. And what about companies? Guys, companies is very interesting. Not very important at CA inter level, but still we'll do it. This is a domestic company, also called an Indian company, and this is a foreign company. The basic tax for a company is at the rate of 30%. And if not this year, not last year, but last to last year, if your turnover was up to 400 crores, then which year, not 2021, not the current year 21-22, not 2021, but 19-20, if your turnover is up to 400 crores, then you would be taxed only at 25%. So this is a special rate. Yes, this is a special rate. But foreign companies unfortunately are taxed at 40% higher rate. Yes, higher rate. No rebate because they don't vote. Surcharge compensates for the higher rate. The surcharge for foreign company more than 1 crore is just 2%, and more than 10 crores if the total income is, then is 5%. So very low surcharge. Imagine individuals who pay 37%, how they must be feeling with just 2 and 5%. And what is the surcharge here? More than 1 crore and more than 10 crores. How do you remember? 2 plus 5 is 7, so 7% here, and then 5%, that is 12% here. That's how I remember. 2 plus 5 is 7, and 7 plus 5 is 12. And HEC is the same, guys, for both of them. HEC is 4% and HEC is 4%. This is rates of tax for companies. Alright, guys, just taking stock. This is what we have done today. Very, very good day 1 plus rates of tax. Tomorrow's session we will enter into the world of clubbing of income first. Then we will be doing PGBP next. Then we will be doing set off after that. And we will start off with capital gains. That is tomorrow's agenda. These 4 chapters, I think we should be very comfortable. Along with rates of tax, we will be doing that. So that brings us on the next day. We have salaries to go. Then we will do deductions. Then we will do TDS, TCS and advance tax. And we will do return of income. So that will end our portion on 3rd of March. So that when I see you guys next again on the 18th, 20th and 21st, we can do computation of income, lots of sums. We can do the MCQ booklet, and we can do all that and more. Guys, it's been a great day, slightly exhausting, but a good day. I hope you're understanding well. Thumbs up to all you guys for all the energy and enthusiasm. Good job, keep it up. I'm going to see you guys now tomorrow. For any questions, right here. Thank you. Good night. Alright, ending the session, guys. Thank you. If you have any questions, I'm right here. I'm here actually till the end of the time. So if you have any questions, you can ask me now. Thank you.